Hello, today is Wednesday, April 1st, and this is Simon Harry of the Simon Harry Wealth Management Group. Thank you for joining me today. Yesterday, I had the good fortune of speaking with Dr. Jim Thorne, who works with Wellington-Altus Private Wealth as their chief market strategist. We spoke about a lot of things, including recent market volatility, where we think things are going, what sectors to look at and what sectors to avoid when positioning our portfolios, how governments have responded to this unprecedented volatility in the markets, the difficulty in the overall economy, and also what sort of healthcare response we might expect to see and how long it might take to get through this current crisis. The thing to remember is that we are going to get through this just like we're going to meet any challenge. This is a difficult time, but there is light at the end of the tunnel. Thank you for tuning in. If there's any information that you need, please reach out to me. I can be reached at www.simonharry.com. That's SIMONHARRY.com. I hope that you are well, that you are safe, and good luck. We'll talk soon. Is Tuesday, March 31st, 2020, and we have Jim Thorne coming in fresh from Florida back to Toronto. How you doing, Jim?
I'm doing great. How you guys doing over there?
Well, everybody's hanging in here. We've got the wife and kids out for a moment so that we can get everything quiet here so that we can do a bit of an interview with you. Thanks for taking your time.
Not a problem.
Yeah. What we want to do is just kind of get a bit of an idea of what is going on in the markets today. We've had a historic meltdown followed by a historic bounce back. The markets went down faster than they ever have before, and then they bounced back faster than I've ever seen before. And we've got unprecedented cash flowing into the market from the Federal Reserve in the United States. We've got government support all over the place. No doubt there's a lot of problems in the overall economy. Everybody's sitting at home. Nobody's eating out at restaurants. Nobody's going on cruises or on any trips or anything like that. Where do we stand right now, and what are your thoughts on the current market environment?
Okay, well, let's go back to, like, say, December-ish, where we came out of 2019 with a really strong year for equity markets. And we had always been of the view that when you have a strong year where the S&P is up 28% plus dividend yields and what have you, that you typically have a pretty strong correction in the first quarter. Stock market was expensive. So we were thinking that there'd be a pullback of, let's say, 10 to 15%, 10 to 12%, which is typically happens during the year. And that's normal, and that's healthy and natural. We didn't foresee anything like this, right? We didn't foresee a virus forcing the policymakers to shut down the global economy. And but there we are. Right. So when that happened, we had a couple of things happen, right? We have three things I look at. And the two things that I really look at, because there's so much noise in the equity market, is the currency market and the fixed income market. And the two safe havens in the currency market were the Japanese yen and the Swiss franc. And they bottomed March 9th. And if you look at the 10-year yield in the US and the 30-year yield in the US, they also bottomed March 9th. And the equity markets continued to go for another period of time, a week and a half. And so if we're just using the information in the currency and the fixed income market, we're saying that the equity market overshot. And so I'm in that range where it's overshot is about between 2,700 and 2,800 on the S&P 500.
So this is kind of one of the danger zones that we end up getting into, because I really want to have our conversation be something that everyday people can understand, and so what we want to do is kind of get away from some of the jargon and some of the industry speak that we're going to end up falling into.
Right.
So a lot of what you were just talking about were things like the 10-year yield, the 30-year yield, safe havens, which would be like the dollar or the yen, um, and you know, so just to translate all of that is when there's a big pullback or there's a lot of trouble, what we tend to see happen is that certain things do very well because everybody wants to be safe. And when everybody feels like it's safe to get in the water again, then all of a sudden you'll see other things like stocks or high yield corporate bonds. Different asset classes will do better in different environments. What you're saying is that all of those safe havens that we've seen in the past that have done well during times of great stress, that all of these safe haven environments kind of showed their maximum potential. They showed their maximum potential basically about 2 weeks ago.
Yes. So not to get too esoteric, right? There's the safe. I look at safe haven assets to get a gauge on when the equity market overshoots. And so that critical point in time that the equity market started to overshoot was March the 9th, which was saying that all of the assets around the world started to price in this COVID-19 crisis. The ones that everybody, central banks watched, said that, okay, March 9th, it's priced in, yet something happened in the equity markets that provided a liquidation that provided them or drove those assets to be overshoot, to become very, 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 very cheap relative to other assets.
So this is something that I've come back to people. I deal with people, with everyday people mostly, and this is something that we've come back to again and again when people are coming for advice on what to buy and should I be in the stock market, which is a big question that I get a lot. When you're looking at the stock market in general and you're seeing a huge liquidation like we saw where everything is going down and down, and the biggest fear for people is that what happened today and what happened yesterday is going to happen again tomorrow, and then they look and it happens again and it happens again, and it's this huge sell-off. That was actually a forced liquidation. Could you tell us just a bit about what are some of the forces that would force a liquidation like we saw?
If you borrowed money to invest in the equity market, the compliance department or the risk department would come up to you in one of these extreme sell-offs and say, we want our money back. Please liquidate your positions. So you may want, like Disney or IBM or the Royal Bank of Canada, but the margin department or the compliance department or the risk department is forcing you to sell. That's the move we saw in the last 2 weeks of the equity market. It was forced selling. So valuations and fundamentals did not matter. It didn't price in. It was pricing in Armageddon, right? And so what's so important for us to understand is typically psychologically speaking, when we go through a normal correction, we typically go to, oh, this is the end of the world, right? Whether it's a 10% correction or a 35% correction. When you start to see deep value managers come in and say, the stocks are trading at generational valuations, that's when investors need to, as Warren Buffett would say, when everybody's fearful, I want to be greedy. And all of the investors like Warren Buffett got very, very greedy and started buying the market. And so that's what we saw in terms of the bottom being put in, was these fundamental investors started to buy the market, and the liquidation forced by the people that lend the money to invest stopped. And that's what we're starting to see right now, is you're starting to see people sit there, like Boeing got down to $85. 2 weeks before this correction happened in late February, the stock market was at an all-time high. Boeing, even though they had all their problems, was a $400 stock a year ago. It was a $300 stock a couple of months ago. It traded down to $85. I can go through big billionaires, big billion-dollar leading companies got thrown out baby with the bathwater. That's very, very interesting. And so what we need to do is to help our clients is to sit there and go, not to see the danger, but to see the opportunity.
So, I mean, we've seen that on a number of different companies like Johnson & Johnson, Microsoft, you know, like you name it, Hydro One, Fortis, you know, Royal Bank, Bank of Montreal. The list is endless of good quality companies that got completely killed because, again, it's this huge liquidation as we're discussing. You know, when you owe the bank money and they're asking for it back, you got to sell whatever you've got to make sure that you're making those payments. One of the things that we saw last week that was huge was an announcement, basically, from the Federal Reserve in the United States that they were going to come out and support the market with large asset purchases called quantitative easing, which basically is the Federal Reserve of the United States creating enough money to support the entire market fundamentally. Could you talk to us a bit about what that is and how that works?
Well, in very simple terms, so Simon, you have $100 bond in your hand, and you can't sell it because everybody is upset and scared about COVID-19. The Federal Reserve comes to you and says, I will give you that $100. So the Federal Reserve gives you the $100 and takes that bond away from you. You are now sitting with cash, and you can do whatever you want with the cash. And so there was a two-step process that the Federal Reserve did in conjunction with the Treasury and the White House. Was they had a $2 trillion, so let's just step back for a second. The policymakers feel that to get ahead of the COVID-19 virus, they want to put the global economy into an induced coma. We're going to shut this thing down for however, another month, whatever. It's called timeout. Nothing happens. And what the central bankers want to do is to make sure that anybody that's got a job, or if there is a contract that needs to be fulfilled, there will be money on hand so that nobody goes bankrupt, contracts are met, and people get paid. There was a bill for $2 trillion to do that. But within that bill, there was $450 billion targeted by the Treasury into a fund that's called the Exchange Stabilization Fund, which is ESF. The Federal Reserve can now take that $450 billion and leverage that up 10 times. And they do that through creating money out of thin air. So this money doesn't go onto the deficit. They are just creating it out of thin air. And now the Treasury has not 2 trillion, they have almost $6 trillion to basically put anywhere they want in the economy to help companies or individuals or industries ride out this time when they are shutting down, mandating a recession, putting the economy into an induced coma, on the proviso or the hope that in May or late April or whenever the cases decline, when the economy opens, there's nothing damaged. So that when demand comes back, everything is going. So restaurateurs or airlines or whoever that's got affected by people doing what we're doing and self-isolating, when we go back out and we start to spend, right, the economy is there so that we can absorb that aggregate demand or that demand and have the economy grow again. So it's unprecedented that they did this early in the crisis. So it's not what we would call a bazooka, which is what Chairman Bernanke called it in last decade when he developed it. This is more like a neutron bomb. $6 trillion. The US economy is $20 trillion. So think of that. Make it 18. So this spending package is 30%, almost 30%. Somewhere between 25 and 30% of GDP in the United States to support the economy as we attack this COVID crisis.
And the amazing thing is, like you're saying, is that this was rolled out within weeks. So it's I saw the deputy chairman of the Bank of Canada speak about 2 months ago, and she was talking about this. I mean, nobody saw this coming, and so one of the interesting things that she said over this lunch was that that they had a whole bunch of contingency plans. They could do a lot more than just lower interest rates, that they could go in and do quantitative easing, create money, buy investments, support the markets. And that was in Canada. They had all of these contingency plans. And apparently in the United States, they've had these on the shelf for a while because they came out extremely aggressively.
So the Bank of Canada is doing that. It's just not of the scale. The scale that the Americans is doing is breathtaking.
Yeah, yes, absolutely. One of the things that you had touched on is you mentioned the restaurant space. I do have somebody that asked me to ask a question about the service economy and the hospitality sector. And one of the questions is, with all of the damage that's happening, everybody's staying home, everybody in quarantine, how will the service economy and hospitality sectors ever bounce back from the damage that's happening right now?
So we'll put over here, on this side, we'll put cruise lines, airlines, restaurants, hotels, and over here, we're going to put bricks and mortar retail. And over here is a big problem. Bricks and mortar retail has been going down for years because of what Amazon and online retail has been doing. And what this event has done has just accelerated their demise. So there may be bankruptcies after the fact of companies, and they'll never come back. Look at what Reitman's is doing in Canada. Look at what Macy's is doing in the United States. So sometimes when you get a crisis, they just amplify and accelerate the speed upon which something that's already happening in the economy is taking place. So that is the demise of department stores and bricks and mortar stores, right? So that's the one. You go over here and you have restaurants, and airlines and cruise lines and travel. I think it's a very interesting, because we haven't really touched on this, but if we can get, and we do think that the scientists in technology and innovation in healthcare is getting ahead of this and attacking it. If we can get it to the point where we are not afraid to go out, because there is some cocktail that if we do get the COVID-19 virus, we take it and it goes away, or we can take a vaccine that basically allows us to be immune from it, or there are I can get a blood transfusion of somebody that's already got it and I get immune from it, then we're going to go back to yes, washing our hands and social distancing, but we're going to go traveling. We're going to go restaurants. Las Vegas is going to go up. There's going to be people that are going to go gambling. We're going to go to hockey games and basketball games. And I would suggest to you that people are going to go on cruises. They're going to fix this. So I would say to you that the deep value people that are looking for where the carnage is, it's over in that area over there where you've got the airlines, the hotels, the restaurants, and the cruise lines. Trump just announced a couple of days ago that full deductibility for anybody that basically is going to use restaurants or entertainment as a business. So they stopped having it as being fully deductible. Now it's fully deductible in the United States. So they're trying to do some things. So I think over there is very interesting. I don't know so much about old time retail.
Well, and this is one of the things about how you end up positioning portfolios, is trying to figure out what is it that's not going to work and what is it that looks like it will work or has worked and will continue working. and that the carnage that's happened in the sectors that you're talking about, like the resorts and the airlines and restaurants, that those will be supported by governments, and when they come back, they should come back. There shouldn't be too much of an issue there. One thing that I've heard you talk a lot about in the past is I mean, recent past, are some of the things that are happening with the treatment of COVID, with the identification of COVID, you know, finding the virus, testing, etc. You just came back from Florida. You know, you're in self-isolation for the moment, but how are things playing out down there? How are things playing out down here? What do you see happening in the coming weeks, months?
So first off, if I think we get peak hysteria in the media when cases in New York City peak, and everything seemed, if it doesn't happen in New York, it has to happen in New York for it to happen anywhere in the United States. So that's the first thing. So middle of April, that's what we thought from the beginning, you know, looking at all the curves from around the world. So that's the first thing. So Abbott Labs has come out with a 5-minute test, and your doctor can give that test. And why that's so important is early on with this crisis, we could go into the hospital with all the symptoms and get a test. If we could find a test, it would take 6 days for that results to come back. So meanwhile, you and I are infected, going around and infecting everybody, right? So if we can do a 5-minute test and we can identify whether or not we have the virus, that's the first thing. And also it's non-invasive, which means you don't need to have a gown, you don't need to wear a mask, you're not taking blood. It's a swab that goes into your nose and it goes into a machine. Most of the machines exist already in doctors' offices in the United States. It's like it's a traditional test. So that's first thing. And then we've got a short-term solution, or a bridge, which is a cocktail or drug cocktail, which is three items. It's a hydroxychloroquine, which is a drug that's used for malaria, Z-Pak, and Z-Paks are given to anybody that basically has bronchitis, or if you ever get a bad case of pink eye, so it's an antibiotic, and zinc. And they found it, and it started with the French studies, that two of them, that it really works. In fact, if you go back some, they looked at this on chimpanzees in 2005, and found that it worked in chimpanzees in the United States. So now we have a cocktail that if you take it, the symptoms go away in about 6 days if you take it early enough. So let's think about this now. I think I've got it. I go to the doctor. She tells me in 5 minutes I do, and then she gives me this. Then she gives me this cocktail, which cures me of it. And oh, by the way, once I'm cured of it, I'm immune to it, right? So now the doctor can take my blood and take and use that to help other people, right? This is what they did in 1918. So that's two things happening. And third, you have companies like Johnson & Johnson working on a vaccine. And so when you hear these big numbers, in the model, they're assuming that we don't do anything for 3 years. And if it's like a flu, we're going to go through 3 flu seasons for us to come up with the numbers of 100,000 or 200,000. Well, we're already doing social distancing. We have now a 5-minute test. The FDA's approved this cocktail, right? We're getting the pills in the cocktail to people's hand. People are even thinking about it being an early treatment. Like the malaria drug, we would take that early if we were traveling to an area in the world where we had malaria, right? We get that early enough, and then we get vaccinated, right? Because I would suggest to you that we should think about it. It's going to come back. This is the problem a lot of people have with the testing. So we self-isolate for 2 weeks. It's still out there after the 2 weeks or the 4 weeks. So we sit around the house for 4 weeks. It's still out there in May. Now there's a hope that heat and humidity takes care of that, right? But when you look at what the science is doing, we're way ahead to be able to battle with this. I think the last thing I would say is I hope we come up with a community response. This will not be the first virus that we are going to deal with. In fact, let me just be a little bit more blunt. I was living in Washington, D.C. when Toronto had SARS. I thought that we would be a heck of a lot more prepared than we were, because we've already gone through this, right? Singapore's already gone through this. South Korea's already gone through it. The United States didn't really get the SARS. So where's the SARS protocol, right? We need to be able to understand that if the virus comes, the community needs to deal with it, not the emergency room in the hospital.
Well, this is actually one of the silver linings that I see in all of this, is that even though this is hard, and this is definitely hard on everybody, but this isn't an Ebola type situation that we're dealing with. So you know, it's good that there's a relatively small mortality rate, and that we can at least get some sort of protocols in place to help manage this going forward.
They know where it came from. They know how it spread, and we know that it's really not about age, it's about immune systems, right? So I'm very comfortable that over the next 4 weeks, we're going to get some very positive data, and that should be good, because people will then start to expect us getting back to normal.
Okay, and let's see. Another question for you is that we've seen the markets bounce back approximately 20% over the last week. We saw the first Monday this week without a huge sell-off in weeks. Where do you think we are in the market recovery, and how would you position money in this environment?
So two things. I will say, I think the level of about 2,800 on the S&P is very interesting for two reasons. One, and these are all rules of thumb, right? So one is you take the time it took for the correction to happen, which is about 6 weeks, right? And you take the percent that correction was, which for the S&P 500 was about 35%, right? And then you should see a bounce off the bottom of about 50%, and that 50% bounce should take about half the time, so which would be 3 weeks, right? So I think if we, true to form, if we follow that rule of thumb, we get somewhere close to 2,800 by April 15th. 2,800 is also very interesting, because, you know, when we start talking about the currencies and the bonds and how they bottomed and they went the other way, that same day when the S&P kept going down, it was at 2,800. So I think we get to 2,800 in the next period of time, and then from there, I think it's going to be in phases. And let me just explain this. So we've got forced sell. We have people that said, just get me out, I can't handle it. And then you had forced selling. And now you have fundamental managers coming in and deep value guys saying, I'm hypothetical, I'm going to buy a hotel on the Vegas Strip, because people eventually in 2 years are going to go back to Vegas to gamble, and I'm willing to wait 2 years. That's who you're seeing buying right now. The people that are deep value people that are willing to hold for 2 to 3 years. There is a huge cohort of people, the younger people. Remember, average manager in this business right now for long only is their tenure is 8 years. So that means they started investing in 2011, right? I would suggest to you that they feel that we're going into a depression, right? And that we don't see the economic data early enough, or there's enough certainty for them to basically position their portfolios. That is very interesting. Two, if you run a 60-40 portfolio, right? 60 stocks, 40 bonds. At the end of this quarter, which is your risks department and your legal department is going to come in, look at your portfolio and say, you have to rebalance. You don't have a choice. You have to, because you're out of whack, right? That's about $3 trillion. Go ahead.
No. It's just, this is one of the interesting things about watching the mechanics of these markets, is that there's like the stock market's like an engine, or all markets are like an engine, where there's this happens, then this happens, and this happens, and And so there's certain things that happen inside of the markets themselves that end up forcing selling, or they end up forcing buying, which is very interesting. So one of the things that you're saying is that because when people are in a balanced fund, the balanced fund has to stay balanced. And now that bonds have gone up in value and stocks have gone down, that means the bonds need to be sold and the stocks need to be bought.
They're forced to. Do you know how the risk department came into you and told you had to sell? Now they're coming into you and say you got to buy, and you're sitting there going, wait. So and so these are the mechanics. I think the other interesting thing that's going to happen is the conventional wisdom is that we're going to have to retest the lows. So the lows that we were put into a couple of days ago are going to be retested. That's conventional wisdom now. And typically when it's conventional wisdom, it doesn't happen.
Yeah.
So I anchor off of 2003 and 2009 because I lived through them. As Warren Buffett would say, I have an adult memory of this, right? And what everybody was doing was waiting for the pullback. And if you get a pullback, people are expecting a 10% pullback. And maybe you only get a 2 to 3% pullback and people start buying. So you don't get the big pullback to reposition your portfolios. Why do we care? Because typically by the end of the year, by September, there are these managers that are significantly behind their actuarial assumption, their benchmark, their performance numbers, and they have to perform by the end of the year. They can't buy the high quality names. So what do? They buy what? They buy the junky names because they're trying to get back to close to the benchmark. In 2003 and 2009, the fourth quarter, Simon, was absolutely bonkers. They called it the dash for trash.
Right.
And if this goes the way it usually, this is an evolutionary process, and by the fall, we should have good economic numbers and we should have the virus under control. And we should have a vaccine, and we're going to have the testing, and we're going to have much more comfort. Those people that waited for that data, waited to touch it, feel it, taste it, they can't buy Boeing or Royal Bank of Canada or pick your high quality names because they've already priced in the recovery. They've got to somehow get their performance back. And although they tell you we look for high quality managers and yada, 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 they need to save their jobs, get performance, right? And that's typically, so I would not be surprised. I'm not saying, but the last 2 times this happened, you had a really crazy fourth quarter starting in September.
This is one of the most interesting things about being involved in investment markets is that everybody thinks that everything is all rational and straight lines, but oftentimes things are driven way more by emotions. And what my job is to speak to individuals about how to position their money, and oftentimes I'm dealing with people that don't have a lot of experience watching the markets. And as a result, what ends up happening is that they're very frightened because they don't really understand what's going on, and they want to take action in the absence of having any real information, and it's very difficult for them. But this sentiment ends up being something where people end up saying, okay, I don't want to buy until I've seen the bottom. And then when the bottom comes, they say, okay, I want to get a better price because it was a better price yesterday, but they keep waiting for they wait for a dip. And when the dip happens, it just doesn't end up coming there because everybody's waiting to get in. And it turns into this crowd mentality sort of thing. So the like market sentiment and individual sentiment is huge, and you can see it playing out time and time again.
And they go, and the managers, just to emphasize that, in October or November, if this plays out, the managers will be saying that if I don't do this, I lose my job and I have 2 kids in private school.
Yeah.
What am I going to do?
This is one of the things about our business is that people measure you by your performance, and so the pressure on the managers to be in, or at least catch up, ends up making them do things and take actions that oftentimes they might not want to. So that's kind of interesting. One of the things you touched on, as well as timeframes, I just want to mention this again, is that anything can happen in the coming months. Nobody knows exactly what's going to be happening. One of the graphs that we've all seen, or at least we've seen, I know we've discussed it, is that the sickness looks to be peaking as far as the numbers are concerned. They're thinking that within the next 2 or 3 weeks that we should see the peak in sickness and the peak in death in this, as we all learn how to react to this. So trying to figure out what's going to happen immediately next is very problematic, and it's anybody's guess, and speculating on the short term can get a bit rocky. But for people that are looking to put money up for 3 years or 5 years, this looks as good a time as any.
Yeah.
You know, so you know, the time frame is super important.
Yeah, let me give you some anecdotes of what they're looking at. So they're looking at the sad crisis going on in Italy, and you're seeing that they have got it under control, and new cases are starting to decline, and they're getting a handle on that. Now, they don't tell you that the average person who died in Italy is 85 years old and has 3 pre-existing conditions, right? Yeah. Let's forget about getting into the granularity. But if Italy can tackle that extreme crisis where they were so far behind the 8 ball, people are taking confidence that the Americans in New York City will be able to solve it. And once you get these people saying, this is solvable because it's all about probabilities, right? This is all about probabilities. Then people are saying, well, if that's the case, I can still get, and I really like Boeing. I can, and just a hypothetical, it was $400. It's now $150. This is going to be my chance to start building a position in really, really high quality names, right? And so that's what you're seeing in the market. And I think what you're seeing the last couple of days is people really gravitating towards high quality technology names.
Yeah, absolutely. Absolutely. One of the numbers that you were talking about off camera earlier was Microsoft has seen something like an 800% spike in usership in
the cloud, 776% increase. So you think of what we're doing right here. This we talked about retail bricks and mortar on the downside. On the upside, it's the digital economy. It's working from home. It's using computers to talk to each other, having meetings. It's the Internet of Things. It's machine learning. It's 5G. It's blockchain. All of these themes that we're talking about now will get supercharged because of this.
Yeah, yeah. My wife works for a small private school, teaching a STEM program: science, technology, engineering, and math. And the private school, of course, is shut down. But what they've done is they've brought their entire curriculum online. So the kids are being taught virtually, which is fairly revolutionary. And one, you know, there's a bunch of things that come off of that. But I'm just amazed that these children that are 8, 9, 10 years old are as adept as they are with the technology that, I mean, that we're just learning how to use.
So there's a theme, but in evolution, we make the mistake. Well, let's look at fossils. We make the mistake that think that evolution is gradual, and there's a term called punctuated equilibrium. You know, why is it if evolution is gradual, we should see it in the fossils, right? That's where this comes from. And so what in finance, a lot of guys are talking about, or a lot of portfolio managers are talking about, is you get an event like this happens and it shocks the system. And then what happens is you accelerate the evolutionary process into a step function. Evolution is more like a step than it is a linear line going up from the left to the right. And so one of the areas that they're talking about is education. Education is one of the industries, put it this way, 75% of GDP has yet to embrace digitization. One of the biggest areas where they have yet to really embrace digitization is education. Maybe this pushes it over the tipping point and we get a period of extreme evolution in education. Maybe. But this is the stuff that happens, right? It's not gradual. These events are game changers, and then the world and the economy evolves and spins because of this.
Yeah, and you know, this is it's been a very, very good talk. I'm cognizant of the time because we, you know, we can just keep going and going, I'm sure. But one of the thoughts that I wanted to kind of end on is that these changes, these steps, these evolutionary leaps, um, that they happen in investment markets just as they happen in nature, and you know, it's really important to be reviewing what you do have, because we don't want to be fighting yesterday's war. We don't want to necessarily be gravitating towards a lot of the brick and mortar retail names that we might know from the past, thinking that the changes that we're seeing in our society right now are massive, and you know, it's going to be very, very important that we stay ahead of the curve as much as we can. So thank you very, very much, Jim. I really appreciate your time, and I totally look forward to the next time we speak. Do you have any last thoughts or anything else you might want to say or add?
I think we should keep positive, recognize the fact that we're going through a very traumatic period of time, but science and policymakers have put extreme measures in place so that we're going to get out to the other side of this. We're going to be okay.
Yeah, thank you. You know, one of the things that you've done for me is every day I get emails from you, keeping me up to date on what's going on. Really, really appreciate that. Thank you, Jim, for your time, and I look forward to the next time we can do this.
Thanks a lot. You be safe.
All right, take care.